Hey everyone, welcome back to the channel, which is all about income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds to reach financial independence as quickly as possible. And today we're going to review three brand new BlackRock iShares covered call ETFs that are very, very unique. And I know you guys wanted this review. Got a lot of messages asking to review these ETFs. So of course I'm talking about the three new covered call fixed income ETFs. Very, very interesting. The first time I ever seen a fixed income covered call strategy. So of course I'm talking about the TLTW, the iShares 20 plus year treasury bond buy right strategy. Whenever you see buy right, that just means covered calls. And they also have LQDW, the iShares investment grade corporate bond buy right ETF, and HYGW, the iShares high yield corporate bond buy right strategy. So let's check out these three covered call ETFs together in this video. We'll see what they actually hold, right? It's always very important to know what's the underlying securities that these ETFs have, and we'll see the past performance as well. So we'll do a nice analysis, and hopefully by the end of the video you should know if these ETFs should be a good fit for you. Let's get started. All right, everyone, so let's start with TLTW. What is this ETF? Well, basically what it holds is a ETF that has the 20 plus year treasury bond ETF. So this is government bonds, very, very, very boring. So the underlying of this ETF is basically this one here, TLT. So what they do is they take this ETF, the 20 plus year treasury bond ETF, which is very, very boring long-term treasury bonds, and they write covered calls on it. So that's all that TLTW is. And LQDW, sorry about that, this website here. LQDW is the investment grade corporate bond. So what does investment grade corporate bond mean? It means it's companies that are very, very good quality company. Investment grade will mean high quality blue chip companies. So LQDW, as you might have guessed, just writes covered calls on the LQD ETF, which is also from BlackRock, right? LQD is simply investment grade corporate bonds. LQDW takes that ETF and writes covered calls on it. And as you probably guessed, the third one here, HYGW, the iShares high yield corporate bond buy right, is basically HYG, which is the high yield corporate bond. So these are, non-investment grade. So they doesn't mean they're bad companies. It just means that they're companies that are more, a little bit higher risk, I guess you could say. So this is corporate bonds or corporate debt from companies that are not investment grade. So sometimes these bonds are considered or called junk bonds. I find that very, very funny, but basically you just won't have, top quality companies like LQD has in this one. So you'll probably get a little bit more higher yield, a little bit more higher risk. So it's very, very simple what these three ETFs do, right? They simply hold those three underlying, which if you ask me are very, very boring, right? TLT, government bonds, investment grade corporate bonds, and HYG is the high yield corporate bond. So pretty boring stuff and conservative stuff, all fixed income here, as you could see here, right? Fixed income, all three, but they write covered calls to generate income. And I was extremely surprised, first of all, to note or to see the level of yield so far on these investments. So there's just two distributions declared. I'm assuming that when this video comes out, there's probably going to be the November one. So let's just take a quick look at the yield or the potential yield we could get. So two distributions so far. These are going to be monthly. So 55 cents, 64 cents a month so far. So if we just do, let's just get 55 cents times 12, we're looking at, an annual yield. Of course, this is just an estimate. It's only based on, let's just say, the first distribution of $6.66 annually. When if we try to, calculate the annual yield, we just divide it by the current NAV price here times 100. 19.5% yield, guys. So this is extremely surprising to me. This is extremely high yield. I would have never imagined in a million years that the premiums are so rich on these ETFs, but I guess they are. And it's the same type of deal for the other ones as well. We're talking about like between 15 and 20% yield. Of course, keep in mind, these are just estimates. It's just based on the first two distributions, 55 cents, 43 cents for the investment grade one. And then you have 58 cents, and the October one was big at 78 cents for the just the regular high yield corporate bond or the junk bond one. So extremely interesting high yield potential. This gets me very excited, not only because I don't think I've ever seen covered calls on fixed income, but I mean, this is really high yield. But I mean, now's probably a great time, or probably will have the highest yield because of the volatility. You could see that here, right? This fund may outperform in outperform just means, you know, does better than the general market in periods of rising rates, which is exactly what we're experiencing now, rising interest rates. And they all say this pretty much, rising rates, right? So obviously these are doing really well now, but what if, you know, when the market goes back to normal, will these yields be just as high? Will these distributions be high? Well, unfortunately, we can't know because this is a very new product. So this is why I feel, you know, we should wait at least 6 months to see what the next you know, distributions will be. But very enticing, very high yield and exciting to say the least. They all have very small management fees at 0.35, which is the same. This one's at 0.34, so same MERs as JEPI and JEPQ from JP Morgan. So very low management fee, very attractive as well. The junk bond one has the highest one, but at only 0.69. And if you guys click on product brief, you'll actually get really good information here. So this is what you will get, and you basically get what these 3 ETFs do. So this one here, they all sell covered calls, obviously, on the underlying ETF, which we've seen, right? So TLT for the first one, LQD on the second one, and HGY on the third one. So they just sell covered calls on those ETFs. And on the first one, it's 102% of the closing value. So it basically means 2% out of the money. So you are getting a little bit of growth, or capturing some growth if it goes up. But the other two are 100% of the closing value. So these are more aggressive at the money covered calls. So, you know, things like basically what QYLD does, RYLD, XYLD, they do at the money, which means, you know, very high premium, but little room for growth, which I kind of like this because these things don't really grow that much anyway, right? It's corporate bonds, corporate junk bonds. I mean, this barely grows anyway. So I think it's really a good way to get maximum income. I kind of really like that. So let's just check real quick the underlying. So if you want to look at the performance, you always got to look at, you know, what's inside this covered call ETF. In this case, it's very easy. So if we look at this one, the 20+ year treasury bond, if we look at the performance, it's been around for a long time. You could see that it's pretty dismal, right? In the last 10 years, it's barely 1% return. Inception is 4.5, but I think these things have been around such a really long time. I always like to look at the 10-year one. So pretty much nothing here. LQD, the investment grade, if we look at the performance, a little bit better at 1.5%, and I'm assuming this one's going to be even higher. Yeah, at 2.77%. So obviously, you know, usually this is what happens with more risk. There's more yield, and I find it quite funny. You know, right away I'm attracted to this one the most. Right out of the 3, this is the one I find the most interesting. And right away in my head, I thought, you know, people are going to be the least interested in this one for sure. This is the one I see having the most yield, right? Even though it has the higher management fee, and yeah, I mean, it's just junk bonds, right? It's not as safe as the corporate bond, the investment grade bonds, or of course government bond. But this is the one I'm most attracted to personally because I think it's going to have the most yield, right? So very interesting stuff here, guys. And another thing we could also check out is the underlying. Let's see how they done in the last year. So this is the first one, the treasury bond ETF. Look at the last year, minus 35%, pretty horrible. Of course, now maybe it's, you know, time to spike up. So minus 34%, investment grade minus 23% in the last year. And what do you know? The best performing one is actually just the high yield corporate bond one, the junk bond one, only minus 15%. If we look at 5 years, minus 16, 5 years, minus 16. So about the same with the investment grade compared to the non-investment grade. And then 5 years is minus 23%. So the one that looks the most interesting to me would definitely be this one here, the third one. But to each their own. I mean, it's really up to you guys if you want to make this part of your portfolio to figure out which one you want, or you could just get all three. But I mean, I see the most yield potential and even the most growth potential, like we saw the total returns. This one has the highest total returns in the last 10 years compared to the other ones. But it's really up to you if to analyze and whichever one you want. Obviously, this one is going to be the most safe, right? The least volatile, I would say. And this one's in second place, and this one's probably going to be the most volatile just because it's a bit more risky. But yeah, very, very interesting stuff here. And I was right. I knew like this one is probably going to be the most popular. This one has almost 22 million of assets so far. This one here has 18, and the last one has only 9. So of course, this is how I know that I'm on the right path. I'm always a contrarian when thinking about investing. So this is definitely the one I'm going to be watching the most, but I'll watch all three of them. Curious to see the dividends in the next couple of months. So very, very interesting ETFs, guys. Let's keep an eye on them. I'm always looking for new, covered call style ETFs. And this is really, really unique. I mean, I would have never thought they would be able to do covered calls on fixed income. They're doing it on crypto. They're doing it on fixed income now. I guess you could write covered calls on anything. I mean, I absolutely love this strategy. So this is, my review of these. It's quite early to tell, but don't forget, what you're really investing in. When you're investing in this, you're really investing in this ETF, right? No, sorry, it's this one with covered calls. If you're investing in this one, it would be, the invest LQD with covered calls and the third, et cetera, et cetera. So, yeah, very, very interesting. You could read this document, which tells you pretty much how it works, but it's just a regular covered call strategy, more or less at the money for these two and a little bit out of the money for this one. So very, very interesting. Let's keep our eye on it and, look at what the next couple of distributions are going to be. And, if we're talking 15% plus yield, they could be very, very interesting for us Canadians to put in our RRSPs, but also for you Americans out there watching. This could be a good complement to things like QYLD, RYLD, XYLD, JEPI, JEPQ. I mean, now you could even get fixed income with covered calls, which is absolutely incredible. So really cool ETFs. Let's see what happens. Thank you so much for watching, everyone. I really appreciate it. Don't forget to hit that thumbs up button, that like button, and make sure you're subscribed not to miss out on my future content. Of course, hit that little bell next to the subscribe button so you're notified for any new content that comes out. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once, which is awesome. So this is a companion tool. It's a reference tool that will help you build your own portfolio according to your needs and goals. And it covers both the Canadian and American and US stock markets. So make sure to check it out. I have a video explaining from A to Z exactly what the product is. I showcase it, so there's no surprises. If you're interested, make sure to check out that video. Also, right there on my website, on the homepage, I do offer a one-on-one coaching session with me. So this is a 1-hour Zoom call with yours truly for, in case you need personalized help. I'll answer all your questions and I'll help you best I can. Just remember, I'm not a licensed financial planner or financial advisor. These are just going to be friendly conversation, right? It's just going to be my opinions. But if ever you're looking for that personalized touch, that personalized help, you could book a one-on-one with me. Make sure to check out the message on top of that calendar. That will give you a status of my bookings for that month. Also, we do have a Facebook group, great Facebook group, over 12,000 members. So make sure to join our community. The group is called Passive Income Investing, a nice Facebook group where everyone is sharing their thoughts and opinions and sharing their experiences. So it's a really nice group. We make sure to stay on top of the scam and the spams, and we delete those right away. So make sure to join our Facebook group. If ever you want something more personalized with us, you could follow us on Instagram. That's where we post more personal things on our adventures here in Panama. So follow us on Instagram if you want. And how do I always leave you? Continue to stay safe, continue to stay healthy, and of course, stay passive. See you next time.